what are some key elements of technical analysis? Maybe you've heard technical analysis, maybe you've heard some of these things before, but let's just break it down. Support. The key to technical analysis is finding where the support is. Now, what do I mean by support? I'm referring to buying pressure. Where are investors comfortable purchasing this stock? And sometimes it's a whole number. Sometimes it's maybe a moving average. Sometimes the 200-day moving average, you could also call it the 200-day simple moving average, holds a support line. It represents it's a safe place to purchase the stock because support levels cause the price to hold at that price level. When we say the stock is entering support levels, what we're saying is the price per share of the stock is going to have difficulty going any lower. We're going to see buyers. It's generally safe to buy at support. Now, the opposite of that would be resistance. When the stock runs up, it has a big rally, and the stock really gets stuck on a price. And now maybe in the past, there was a high price the stock couldn't break. Often, it will repeat itself. If a stock couldn't break $90 and the stock goes down, when it comes up to $90, it's going to have trouble breaking through $90 and going any higher. That's known as the resistance. It's resisting the price. And there's different things we can talk about. We can talk about how a stock price is at support level or how it bounced off the support level. But we'll go into more detail and we'll go into different examples. And let's talk about trend lines. Now, trend lines are important because the support and resistance levels can either be horizontal on your chart or they can follow the stock. The stock can make higher highs, higher lows for an uptrend, or lower lows, lower highs for a downtrend. Maybe you've heard that before. You don't want to look for higher highs, higher lows. You don't want lower lows, lower highs. That's a downtrend. And the trend lines basically follow the stock. They follow the highs the stock makes. They follow the lows the stock makes. And you can have one trend line. You can have two trend lines that the stock bounces up and down in between. That's called a channel. You can have a bunch of different patterns like wedges or flags, or some people really like to get into it and they say, oh, this is a bull flag pattern, or this is a upper wedge, or this is a condensing wedge or a breakout wedge. Again, we won't go too technical into it. I'll just show you what the technical analysts are talking about. If you really like the technical stuff, you can do a little more research on your own, but I'll give you all the information you need to use a basic strategy. And the basic strategy is for technical analysts is to buy at support, sell at resistance. Now, what happens when a stock breaks through resistance? Usually we see a big up move. When a stock breaks through support, we see a big downwards move. And there's a bit of a rule. Basically, the rule is if a stock breaks resistance, the previous resistance becomes the new support. If a stock breaks support, it becomes the new resistance. Because it's kind of using the mentality of traders. Traders like to use whole numbers for support and resistance. I think there's two reasons for that. One is people like to mentally purchase stock at whole numbers. And two, similar to this, is they actually put their buy and sell orders in at whole numbers as well. So they'll put in a limit order at $30. They'll put in again, stop loss order for the resistance above maybe at $90. So you want to buy at support, sell at resistance. Again, we can be talking about horizontal support, horizontal resistance, or maybe we're talking about trend lines where maybe we're at a 45-degree angle and we're buying that lower support line and we're selling the upper trend line. Again, we're buying the lower trend line, we're selling the upper trend line. We'll do a demonstration so you'll see exactly what I'm talking about. We'll mark up a chart. But technical analysis could refer to moving averages or moving average crosses. Again, it's called the death cross when the 50-day moving average crosses below the 200 moving average. So just to give you an idea, the technical moving averages are most commonly known as 20-day moving averages or 50-day moving averages or 200-day moving averages. It's basically taking the average price over 20 days, 50 days, 200 days, and dividing it by the time frame. So it gives you a moving average. And if it's above the moving average, you can call that an uptrend. Below the moving average, it's a downtrend. And patterns can form double bottom patterns, double top patterns, wedges and different patterns. Again, there's a million different patterns. I'll teach you a couple patterns, but you don't have to go too crazy with the patterns. And a lot of technical analysis guys, they really love indicators. And what I don't want you to do as a new investor is get obsessed with the indicators or thinking the indicators are going to give you an advantage. And there's really two types of investors out there, or technical analysts out there. There's ones that use indicators and love indicators and rely on indicators, and then there's ones that just use the price action. What do I mean by the price action? Basically what the price is at, and making a system or strategy or trading off the price, not using indicators, just focusing in on the price. And if I had to design my perfect trading protege, if I had to teach someone, which I'm doing, about the stock market, I would say avoid the indicators, use the price action. I don't recommend the indicators because they're delayed and they can create confusion. The indicators only have one job, and they're designed to tell you when the stock's oversold, meaning the stock has a lot of investors selling it and perhaps it's a good time to buy. Maybe it's at support levels. Again, oversold and support go together, just like overbought and resistance go together. Overbought means the stock's had a huge rally and everyone's bought in, and maybe the stock's due to decline simply because it's at an unsustainably high level. And let's talk a little bit about a short squeeze. Again, this is a little different than indicators like the title, but it's important you know what a short squeeze is. So when you short, you must cover, meaning you sell shares you don't own. Your broker helps you do that. You have to pay your broker back. You have to cover those shares. If you short high, you cover low. So you short 1,000 shares in your brokerage account, it will say negative 1,000 shares. Maybe you sold short at $10. Ideally, you'd want to cover at $7 or $5 or $3. Again, you want to cover low, and then you want to pay back those shares. You want to buy 1,000 shares. So that's all you need to know is when you short stock, you must cover stock. You must buy to pay back your broker. It's called covering. So when everyone's short, a big number of people are short. It's called a high short interest, or the float has a large percentage short. Again, we'll talk more about the float and stuff like that later. But if everyone is shorting a stock and the stock starts to rally, everyone's going to start to cover. If they realize, well, this is probably as low as it's going to go. I need to pay my broker back. I need to cover the shares. I need to buy the shares. The buying pressure sends the shares up. The buying pressure drives the shares up. And so it causes the price to increase. And as the price increases, more people cover, which is more buying. And then the price rallies. And then that can create what's known as a short squeeze, where there's this massive up move caused by short sellers covering their stock. And sometimes it can be quick and it can be quite explosive. So I had to fit the short squeeze in somewhere. Why not in the technical analysis section? So that's what a short squeeze is when everyone's covering, and usually it's a catalyst. It's what catalyst means change. And a catalyst in the stock market world, it generally means news. There's some positive news. Everyone's buying, the shorts are covering, and it causes a massive move upwards. And so we talked a little bit about what technical analysis is, but let's see if we can do a pretty good demonstration to give you an idea what it is. So we'll zip over to stockcharts.com. Give me a moment here.